Welcome to the Dividend Talk podcast, episode 161. Our appetite to risk when seeking financial freedom. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavor. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJ. Another weekend, another podcast, buddy.
Haha, yeah, time continues to fly, but I'm really happy. It was a good week and lots going on in the market, right? There seems to be a bit of decline in the market, which for me is really nice because in these times I always feel like a kid in the candy store. There's just too much to choose at a certain moment. But I had one good thing this week. I had no cash to invest. I was living since Monday on 40 euro, trying to find money for food effectively, but I got my salary today, so I can finally splurge a bit again and invest also a bit next week again in dividend growth stocks.
Yeah, few people will understand how good that actually feels sometimes, that you're just living right at the edge of where you need to be. No more, no less. You're right at the limit.
Yeah, that's the result of paying yourself first, right? So when my money comes in, half of it goes straight away to the investment account, and with the rest I need to live. And this summer was a bit expensive, specifically the last month. My kids had certain desires to go stuff, so I was just splurging. But then, yeah, you have some more days left in the end of the month, and yeah, but I cooked a bit more at home to save costs as well, so it was actually not so bad.
Yeah, it works out better, nice and healthy for you as well. So but it's a win-win.
Definitely,
Um,
definitely.
but hey, let's touch on some news this week. And unless you lived under a rock, it's hard to ignore NVIDIA this week. They've been absolutely all over the news, and for good reason. I mean, that was quite a beat that they had on their earnings this quarter.
Yeah, honestly, I mean, I have never seen, since I'm following the stock market, I've never seen such an earnings hike. Um, Revenue was up to 30.5 billion, 88% more than in the first quarter. So in a single quarter, they were able to double almost their revenue. And I'm just envisioning how this goes, right? With the factories and everything, or how, I mean, they must be on full steam everywhere, and they probably outsource the manufacturing. I'm not I don't know the company well enough. I'm just thinking like, how if they would tell us at work over the next 3 months you will need to double your output. I can't imagine how we would do that. Could you imagine?
I couldn't imagine doing that over 2 years, let alone 3 months.
No,
I
but this
mean,
company pulled it off. Probably some price hikes, so it might not be pure volume, but this is what is blowing me so so much away when I look at this at these numbers. The thought behind it of that they must have done this in 3 months. This switch, it's just crazy when you think about it.
yeah. It's probably not 3 months in the making. That they obviously had worked their way into that, but I mean, looking at some of the highlights from it, it's staggering the numbers that they've managed to achieve. And they've even gone as far as saying, and the CEO is on record as saying, a new era of computing has begun. And if you look at the broader context of that, what does that mean for the likes of Intel and other players in this space?
Yeah, well, that's the thought that always comes up to me when I see Nvidia performing like that, and I think like, oh, Intel, where did you lose your mojo? Yeah, they started at the. I could see it. If you look back, they didn't invest enough in capex. The capex that they were investing was also not effective. With who was a Bob Swan at the time.
Yep.
He was just like an account manager effectively, and now Pat Gelsinger needs to fix a lot from the lack of investment. And these have long lead times, right? And at the same time, NVIDIA is also not sitting still. They have top talent. They have everything going for them at the moment. So it's really, really tough on Intel to become competitive again. But I still have hope on those new machines that Intel purchased. Hopefully they can do something with that and earn some market share back.
Yeah, but you only have to look at the history. At one point, Intel were the top dogs, and they were sitting in this position with everyone scrambling to catch up with them. Now NVIDIA is probably arguably out in front, and everyone else is going to scramble. But that's the beauty of a technology. It just takes you're one innovation away from a game changer and catching and beating your competitors. So there is obviously hope. But again, you would probably feel it frustrating if you are investing in this space and you pick Intel and you see you see the returns you get from Intel versus NVIDIA. It's hard not to be how would you say it? It's hard not to have FOMO in times like this. But I feel sorry. I know there was a lot of people who had shorted NVIDIA in the lead up to this because their share price had accelerated quite quickly. I'd say they must be hurting pretty bad now after this.
Yeah, that's why you shouldn't speculate with options. Anyway, this is just if you're an investor, even dividend growth investor. I mean, you like good businesses, and I think this is an example of a good business.
They pay a dividend, don't they? It's really, really small.
But also dividend growth. I checked it. It's not worth it. I don't call the dividend growth stock. No.
It'd be one of these companies that's sitting your Apple, or not your Apple, your kind of growth portfolio.
In this few percent per section. True. But I don't own it, by the way. Disclosure. I don't own it, and I have no intention to own it in the short term.
No. Well, Jim Cramer said buy it, so it's probably a good time to sell.
Oh, yeah, but he has a dog called NVIDIA. By the way, if you would have a dog, how would you call it?
My last dog, he only passed away recently, actually, about 3 weeks ago. His name was MJ.
MJ.
Yeah, so after Michael Jackson, and the reason for that was he was a cross between a Labrador, so a Labrador is black, and a golden retriever. So he was both black and white. So we called him MJ.
But now, if you get a new dog, what company name would you give it?
What company name would I give it? I would call him probably Microsoft. Here, Microsoft.
I would maybe do then to mix it up. I would do Ahold. Hey, Ahold, come on, go on, Ahold.
Brilliant. Okay, let's move away from non-dividend growth stocks and talk about one that is more inclined to be known as a dividend company, and that's CVS Health. They've been in the news again about a new brand that's targeting the biosimilar market, I believe.
Yeah, so CVS is struggling, right? Their stock prices went also really down over the last weeks. I don't find their dividend really safe. I don't think they have an issue on the short term, but on the midterm, it's not sustainable in my opinion. But what they announced this week, and I think they're also desperate to create some narrative around their company. But they have launched a new brand, Cordavis, which is trying to get a share of the pie of the biosimilar market, which they believe will be 100 billion in size by 2029. And what I found really interesting for AbbVie and Novartis shareholders, they want to target Humira. So the biosimilar via biosimilar from AbbVie. And this biosimilar is called Hyrimoz. And they want to operate in such a way that they don't do all the R&D, but kind of the branding and the last mile, let's say, delivery, the marketing. So they will co-manufacture with Sandoz, which will be spun off from, or which is already spun off, or will be spun off from Novartis. And effectively, they will look after the market in the United States and maybe even beyond. Not 100% sure about that. And they say, that's so funny how they say it, right? they want to really emphasize that they are co-manufacturing. That means that they want to look after the quality of the product as well, and not just stick a label on the stuff and then put it on the shelves. Yeah, but really interesting. So this is sometimes nice, right? If you have AbbVie and you're afraid that biosimilar competition will eat up their revenue, you can also play the other side. You could buy some CVS and anticipate on some additional earnings, which it is eating away from AbbVie. You could even buy some Sandoz. I haven't analyzed Sandoz, how it will look like afterwards. There's manufacturing this stuff. So there are always these kinds of setups that you can play, of course, in your portfolio. But I found it really interesting that CVS is now going into the biosimilar market, and let's see where it brings them.
Yeah, it's quite surprising. And we mentioned Viatris as well are gunning for AbbVie's Humira as well. I think there's a list of companies that are going to try and.
Yeah.
I mean, it's the most successful drug of all time.
Yeah.
So there's no surprise people are lining up to do this. But I agree with you. From CVS, I wasn't aware they're in the biosimilar market. First of all, I don't know if this is their first venture in. But you're right, they're obviously trying to create some headlines.
Yeah, and I checked the Sandoz website as well about Hirimos, and it was written that for the 1st of July they started selling this in the States. So that's why I'm a bit confused with the news. I need to dig deeper here, but yeah, this could be a really good deal, right? If CVS has the retail, it has it has all the shops, it has the whole delivery network, the whole supply chain setup in the US. It has all these benefit packages, what they can include it to. Yeah, so they might be more interesting than for patients as well to have their healthcare package with CVS if they get cheaper biosimilars.
Yeah, I mean, look, it makes sense. I know another company, not quite dissimilar from them, are actually involved with the company I work for. I won't say who in either cases, or I'll get sued. But I do know that they do something similar. They take our product, we put their packaging on it, and ship it out to them, and they actually they do quite well in the sales of that. So it makes sense to do that. Why not? If you have the capacity to do that, why not? But like I said, there's only two players in that market. You got Walgreens and CVS in America. I don't understand how the two of them are struggling so bad. I really don't. You've got two big players and they're really, really struggling. But it's interesting. Look, they've taken two different paths now. CVS are looking more probably into biosimilars. They see there's probably a bigger share of the market that way. Whereas Walgreens have gone the other way and are building this health villages and this like all-inclusive health facilities. So let's see what happens with those.
Good. And then still some other news. We always have this section about dividend hikes and cuts lately as well. So how about this one? Altria Group hiked their dividend actually today by 4.3% to 98 cents per share. What do you think about that?
I like it. I obviously, look, they are a high yielding company as it was. I think they were 8.4, upwards of 8 anyway. And now you're getting a 4% hike on top of that. I was not expecting it. I have to say I was expecting maybe a 1% hike or something small. But as a shareholder, you have to be quite happy. I think they're in a good, solid position financially. We know the troubles in that particular market, and they're trying their best to navigate it, even though unsuccessfully in terms of their dual acquisition and stuff. But I mean, they've got the cash, so why not give it back to us?
Yeah, and this is the nice thing, right? When you think about dividend growth investing, it helps so much if you have a high yielder that just continues to grow with 3-4% annually. Then you're so quickly at a 10% yield on cost, and this really helps you fuel your dividend income and reinvesting.
Yeah, I would not be disappointed if they had 1 or 2%. I kind of expected 1 or 2%. 4% was a little bit unexpected for me, but I will take it. I think it's 7 or 8% of my portfolio in terms of dividend yield. I didn't quite buy it at that price, but I've been reinvesting the dividends. I'm up to 106 or 7 shares now, and let's see where it goes.
Well, then a company that is not or hardly ever mentioned on the show, also in the chip industry, Lam Research, they hiked their dividend with by 16%, which is also really nice for shareholders here. I don't expect it in a lot of portfolios. Ticker symbol is LRCX, but yeah, congratulations to the people that own it. Yeah, and we have to talk, of course, about two dividend cuts really quickly. Hawaiian Electric suspended the dividend, but this is of course normal, right? With all the wildfires there, I'm not surprised at all. Also with all the litigation that they get their way, it's good to do that, right? But then the big one, I think, is that also many people in the community own is Medical Properties Trust, ticker symbol MPW. They cut their dividend to 15 cents. That's like a 41% dividend cut. So it goes from 15% to, let's say, 8 or 9% yield at the moment. And I mean, what do you think about this? Because the irony is, right, on their investor relations websites, they had the day of the announcement, when you open it up, the investor relation websites written there, well-covered dividends from inflation-protected cash flows. So what do you think about this stock?
Yeah, I mean, it wasn't so long ago that this was on everybody's lips. It was on every YouTube channel was covering it, Twitter was covering it, and it was quite split because they dropped in share price dramatically quite fast. Nearly over half their share price was wiped out. So you were getting a 14-15% yield at one point, and everybody was jumping on the bandwagon saying, "Oh, the dividend is safe and buy more. It's a great company." But you have to step back and realize: do you really understand this company? What does it do, and why did the share price drop? I'll be honest with you. Up until 3 or 4 months ago, these were never on my radar. It was only because they're on every single channel on Twitter that they popped up, but I never felt the need to buy them. I felt 14% dividend yield, there must be some problem, and I sidestepped it. But I don't think, reading some knowledgeable people's blogs and articles and out there, I'm not surprised that this was happening. I think it was forecasted, and a lot of people expected it that know about these types of companies.
Yeah. So when I saw it passing by, of course, that's why I'm also on social media, right, to get some inspiration. And but when I looked at it, it just didn't met my dividend safety standards. Yeah, if you have, like, for me, the benchmark is realty income as an example. And you have always then this thinking that I heard at the time, like, even if the dividend is cut in half, then I still get a 7.5% or 8% dividend yield. But what people don't often realize is that it also resets the share price. Yeah, because the dividend yield is also a form of valuation and such. So if you bought it at, let's say, double the price, and then the dividend goes in half, expect the price to also have a new floor. So it's not just the dividend income that you lose; you also lose the capital, the capital that you put into it. So you get double screwed, and we have seen this a lot with dividend cuts in the past. Once this happens, usually there's also a new floor in the share price, and it's really hard. You really need to wait long for it to be meaningful. And often we say, like, it's not about total return, but with a dividend cut, I look at that. No, if you buy and with the reasoning, yeah, the dividend cut can be cut in half, and I still get enough yield. I think it's not. Yeah, I really have something against that as being a dividend growth investor. We want to have strong companies, and let me reiterate that as dividend growth investors, it is first growth, then dividend. We want to see companies that have an ability to grow, bottom line, top line, and that should provide them, if they also have a healthy balance sheet and such, should provide them to give them ample room to grow the dividends for years to come. Yeah. So, and that's not what Medical Properties Trust is qualifying for. It's a pure high yield company, and you can use it. You can have it, of course, in your portfolio as a high yield company. But then just know that these companies with such a risk, you also lose capital, and it becomes different conversation at that time than a pure dividend growth investment play.
Yeah, you're dead right. And just even a quick look at their quarterly financial trend over the last couple of quarters, it's down, but it's not down by 1 or 2%. They're double digit, and sometimes even triple digit, 120% onwards. So it's been in decline in both share price and then all these growth metrics over the last couple of quarters. So I think the writing is pretty much on the wall. It wasn't a drop out of nowhere or a quick flash in the pan. it was steadily dropping with earnings, with everything over the last number of quarters. So something had to give. So
yeah, and then I also see. Sorry, maybe some of our listeners will be pissed off with this, but we are having here an unsalted opinion. People are also now investing now because the stock is undervalued. But then I think like, okay, why are we? Because it might be an overreaction, but why then medical properties trust and not PayPal? What do you as an investor know more about the hospital business, which we specifically in Europe we have no visibility on that. We don't walk in through those hospitals that are owned by medical property trust. But PayPal we use regularly, right? When we buy something online, and we kind of know something about this company. So what makes us then be interested in the turnaround play for medical properties trust versus something like PayPal?
yeah,
Or Adyen.
Yeah.
Why this stock?
It's a good point. And why do people invest in real estate investment trusts? They're usually income investors, right? Usually. And now they're getting saying, okay, this is undervalued. There's a chance for this share price to increase. But what about the dividend? What about the income? That's what you're investing for, I assume. Otherwise, you would not invest in real estate investment trusts. That's the only reason you typically invest in these types of companies. So it's like a juxtaposition. You're kind of antagonizing yourself. You're in two different worlds, investing in some company that, as you say, is probably better off investing in someone like PayPal.
Yeah. And look, really, if someone really did the homework and says like, okay, after the dividend cut, like we did with Shell, it was necessarily, we can see it growing from here, and there's a good growth story behind it. Then I can understand it. But that's not what I hear. I usually hear undervalued. It's undervalued, and I don't hear the dividend growth path forward. Because that also means you should sell it once it hits its fair value or slightly overvalued.
Yeah.
So I think it's one of those controversial stocks in the community. I don't touch it. I'm much more better off with realty income or agree realty. Those are like having tenants that are like supermarket chains and such that are kind of resistant to cycles that are also having specifically realty income. They have top-notch tenants, right, with high grade profiles. So yeah, I prefer that much more. Anyway, long story short, watch out with this one, guys. Know why you own it, and figure out if you really need it in your dividend growth portfolio.
Yeah, hey, listen, that might be a nice introduction then into our topic of this evening, where we talk about risk, our risk appetite, and what comes to mind when we think about risk. And I think this came about, we were inspired, as usual, by some members of the community. In this case, it was Javier, who asked us to discuss how we diversify between brokers when you get well over 100K. So I think it'd be a nice discussion to talk a little bit about what comes to your mind when you think about risk and risk appetite.
Yeah, and I take it actually from my path to financial freedom. So let's not zoom in only on the portfolio, but just in general, managing my wealth, my net worth. Yeah. So, and there are a few aspects with about this. And actually, let's start with real estate. Most of my net worth is invested in real estate at the moment because I've got a low mortgage, high interest rate on the mortgage, but let's say there's a lot of equity in my in my real estate. So and that's probably important to mention here because it is a liability in the end. It doesn't yield me anything. It's not an investment. I need to pay it off. I intend to live here until I pass away one day. So I will never be able to generate money from it with our current plans. So that's where most of our money is. And I mentioned one time earlier on the podcast, that's also the reason why I don't pay down the mortgage to zero, because all that is happening at the border in Belarus and everything makes me wonder, like, look, I don't want all my money in mortar and bricks, because if sometime hell breaks loose here, it's gone, kind of. Yeah. So that's also like my appetite to risk is there for also that I don't want to pay off my house entirely and use some debt on it that at least then is for the banks at that time. I'm not expecting it, but it's like, this in the back of my mind when it comes to decision making. Another one then is about cash in the bank. I also don't like too much cash in the bank. And how is it? So the cash in the bank for me is really like my emergency fund, a bit of holiday reservation or vacation money reservation, and then just my monthly bills. That's what I want to have on the bank. I know that in Europe our money is protected to 100,000 euro. But I don't want 100,000 euro on the bank because it doesn't do anything and inflation will eat it up. So that's also for me really something that I have an issue with when it comes to appetite to risk, because the opportunity cost of it. And then the other part of the wealth is really at the broker, and here I have some issues. So generally, I'm positive about the brokers that I use. I use the Hero a lot. I use Interactive Brokers a lot, and I use a bit of Trading 212. Generally, I'm positive about them. The functionality is there. I get my dividends. I'm of course annoyed about that they don't give dividend vouchers so that we can easily reclaim tax from foreign entities. But do you trust them entirely with that your money is safe? Because everything is just digital. We hear sometimes like how brokers in America at the time, which broker was it? Robinhood, how they were dealing with the money. Was it with GameStop? That they suddenly just froze people's accounts and everything. So we know, of course, what happened with FTX, the cryptocurrency exchange. Also, the Hero gets several time some remarks by the AFM, the Dutch watchdog. Interactive Brokers is a US entity, something that I'm actually the most positive of about all brokers. But there's always this feeling like, because I can't see it, I can't touch it, I have this feeling like always like, is the money safe? It's probably one of the most questions asked to Interactive Brokers. So I trust mostly that my money is safe there because the shares are in my name. Yeah, they are, of course, registered by Interactive Brokers, but they need to again keep that money in our name as well. So that's all known. So my shares should be safe. Nevertheless, I do have this rule that when my account goes up above 100K, I want to look at the next broker. There just to spread risk. And this 100K doesn't really matter, I think, because there is no protection towards like money or something. Yeah, well, there's money. If it's a bank account at your broker, you have some protection. I think it's shares. It's up to 20K, something like that. So, and I don't want to open an account after every 20K. Yeah, but I am using different companies, let's say, to store my money and to have a certain amount of shares in there. And then I try to optimize having the Interactive Brokers more for US shares, the Hero more for European shares and such. But that's for me a bit of risk management, that if one broker would really go down, it might be that you may not be able to practically to access your money for a year. Yeah, we see that also with Celsius and some of those platforms. Yeah, one is that it's yours, but second, how are you going to prove it? Do you have a screenshot if they made a mess of their accounting? And third, yeah, will you even have access while the market is fluctuating all the time? So at least then, let's say if you would have 300, 400K there and one of the brokers would go bust, you have an issue for 25% of your portfolio at that time. So that's how I kind of look at it.
So if you use that logic, let's hypothetically say you have a portfolio of 1 million, okay?
Yeah.
By that logic, you would need 10 different brokers, or would you split it with 5 different brokers? And
yeah, I think it would be 4 or 5 at that volume, because I think I would be looking at 25%, 20% risk tolerance on that one.
And would you split it? Because part of the question from Javier is, would you split it between you and your wife, a partner, or family, or would you have it all still?
No, different companies. Because like I mentioned, if I can't access the money and we have I have it on my wife and mine, and I have two
It's the
accounts.
same thing.
It's the same thing. It's the same issue. So I do split it. Again, I'm not saying that any of these brokers is unsafe. To the contrary, I think we have really good financial authorities in Europe that really look after that. They learned a lot from the iSafe debacle as well. They're proactive. Yeah, we can see that with the Hero. So I think we're in a good situation in Europe in general, specifically with the more popular brokers. They get the required amount of attention, and also there are a lot of people like retail investors asking this question, discussing this online. So there's just a lot of talk about this. But still, just in this once in 100 years event, I want to make sure that I can access my money as much as possible. So that's why I'm doing this.
Like the one question I always ask myself with this is, how do the mega rich, how do they spread the risk and spread the money around? Because they obviously have millions, sometimes even
Yeah.
billions. And we're talking here where, look, we're bottom of the pile when you look at it in a certain respect. We're talking about 100,000 or 200,000. But where did these guys store money? Because
Yeah.
they're going to have, say, if you had 10 million, where do you spread that across? I mean, that always
I
crosses
have
my
no
mind.
clue because I'm just a simple middle class man. Yeah,
Exactly, yeah.
I don't know such people.
Do we have bigger trust issues than them? I mean, do they just trust the financial institutions more than they trust us? Are they better protected?
Yeah.
It's quite a strange one, because we're talking about a relatively small amount of money in broader terms, but a large amount of money in terms of the
Yeah.
demographic that we're in. But I'm quite similar. I don't trust the banks. I don't trust them one bit. You see what happened in Greece. You see what happened in the United States recently. When banks
Yeah.
need your money, if your money is in the bank, you cannot get that money. It's one of the reasons why there's lots of these small petitions going on. Particularly, I've seen more in the UK and some in Ireland around keeping cash, because they're trying to get rid of cash. I don't think there's any
Mhm.
secret of that. But it's just for the older generation, even the generation above me, they can see the risk in that. I mean, once the bank has your
Yeah.
money, they control everything. They can set the fees. They can take your money. They can do what you want.
Yeah.
And I don't feel too safe with all my money in the bank. I don't feel too safe with all my money at home, and I don't feel too safe with all my money in investments, because at the end of the day, all of that can be taken away from you by one simple thing.
Yeah, and that's why I distribute all of that and make sure that if one goes down, the other 6 or 7 are still online, let's say. Yeah.
Yeah.
Yeah, that's really how I look at that from a net worth point of view. So the banks, the brokers, the real estate. Yeah, and then about my portfolio itself, I've got like position sizes, so maximum 5%. We also got a question from Marek about that, Marek Nazarko. He asked us, like, what do you mean saying full position, full in target time, or for now? I mean in target time. Yeah, that's for me a full position. So I know kind of if I want to, let's say, be financially independent, I know how much dividends this position would need to generate for me. I know kind of also what that means from a size in how is it, the portfolio value of that one position. And sometimes I say even it's a full position because I know I still have, let's say, 5 years to grow to there. And if it just hikes the dividend over the time by 10%, I'm there. Yeah. So I don't need to put fresh capital anymore. So I that's also for me, again, I mentioned that more often. If one company goes bust, the rest of the portfolio will need to do the heavy lifting. And if my portfolio grows 8 to 10% over year, I can have 1 to 2 companies going bust every year, and I would have a flat portfolio, which in reality never happened. But it is still like how I think about risk. I know this is not like modern risk theory for when you go to university. I had that as well. That stuff way too complicated for me, and not too complicated to calculate, but complicated to manage. Then you need to just be in my opinion, investment manager or something like that does this continuously manage your money. For me, it's there for really like in simple terms, like working backwards. What would happen if a company goes bust? How much do I feel comfortable with? That's how I establish this. I think it's for me it works. Let's say.
Yeah.
And then there's one more thing that I've been thinking about lately. That are two things. One is a margin of safety on my dividend income. So I'm thinking more and more lately that I should have at least a 10 or 20% margin of safety before I would call myself financial independent. You don't know if dividend cuts or something like that, or currency that suddenly devalues with the US dollar or something like that. So I'm thinking maybe I'll just extend it for a year. Let's say early retirement or financial independent crossover date, just to build some margin of safety there. And the last thing about risk is still income sources. So both my wife and I have a full-time job at the moment. And this is also, of course, a bit of risk management. So we don't have one sole provider. If one of us gets sick, then we can live also on the other one's income. So I think from that point of view, I have a really conservative setup financially.
Yeah, quite similar in some respects. Mostly where we differ is probably the income sources. Me and my wife does work part-time now because she doesn't have to. She stopped for a year or two. Remember, I think I spoke on it before. I was able to retire on my wage, but actually the fact of being at home when everyone's in work and not having that social interaction is quite difficult actually. So she does work part-time, which she enjoys, but it's not huge money. It's like if I was out of work for 3 years, she would have to get a proper job, say, like not a proper job, but a job that would supplement the income a little bit better. But we have that risk. We have a buffer behind us in case I do go out of work for a long period of time, roughly 12 months, that we can support ourselves. And she's qualified in numerous different things that she can actually get higher pay jobs if we need. But that's a different kind of risk that we're willing to take. She gets to spend more time with the kids. My kids are younger. She gets to spend more time with her father, her family, and her mother. So I think it's worth the risk, in my opinion. Quality of life over working is much better, at least for my wife. I get to do the other side of it, but I'm happy to do that. I wouldn't like to be doing what she's doing, if you get me. I like keeping busy and working. But one thing I always have to remember with my investments is how that impacts my family life. And we do joke a lot on this because sometimes we postpone because I take a lot of short breaks or vacations, or I'm away on weekends. But you have to think of your family too. If I was on my own, what a sad life that would be. But if I was, I would probably invest a lot more of my income. I could live frugally. I don't need to spend a lot of money.
Yeah, if I would live alone, I would just not even buy, I would just probably rent like a 15 square meter room with a kitchen attached with other people living in it. And there would be like a bed in it, plus one chair and a computer.
Yeah, I mean,
that would be it.
I'd be quite similar, and I'd be retired in about 5-6 years, and
exactly.
And that would be it. But you have to think of your wife, your family, your kids, how it impacts them, and the risk you take. So, how much money can I put into my investments that will not impact their life? And that's a big thing.
I would be that quick as well, because how long can you sustain on ramen noodles, those packages where you add some hot water to it?
Yeah, well, there's plenty of takeaways. I'd be living in the pub down the road. They do roast dinners every day, so
that's healthy and keeps you alive.
Guinness, lots of Guinness. So look, for me, as I said, risk is something important for me, but I have to take into consideration where my wife is. So I try and we structure in a way we pay more off our mortgage than what I would like, but that's where my wife is more comfortable. So we sat down at the start of the year. I invest around 40% of my income in stocks. She doesn't question that, but we do have to put more away then for our mortgage, and that keeps my wife happy. We're both happy, and we can invest in the knowledge that if something did happen, if the banks did shut down, if the brokers did close ourselves, we're not too bad in terms of our living situation now. So we always say invest what you can afford to lose, and genuinely that's what I do. So I don't worry about my money once it's there. It is a hot topic what to do with the brokers and what you do here. I have two brokers at the moment. If both of them go bust at the same time, we have a huge problem. It's probably
Yeah.
going to be a global problem and not just a me
Mhm.
problem. That's the way I
And
look at it.
is anything of your risk management or appetite to risk from a, let's say, financial freedom point of view, a net worth point of view, driven by past experiences?
Yes. So look, no secret, in the past I was a bit of a gambler and tried to accelerate my
Mhm.
path to financial freedom by chasing huge gains, and you end up losing a lot of money. And actually, that's where the family bit comes in. Before, I would have just gone gung ho myself and not worried about what was going on around me. But at least having the family grounds me in terms of I have to have a certain amount of income, a certain amount of money to the side that looks after my family, and that's number
Yeah.
one. That's number one priority. After that, then whatever's left, I can afford to lose. And I've given up chasing the quick path to wealth, and now I'm on the slow and steady path to wealth.
Yeah. Good. 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 Good, interesting topic. I hope it was also useful for the listeners. Our approach, of course, it's not an academic approach that we use. We're just sharing our experiences here, and specifically also the reasoning behind it, why we make certain choices. If you have certain ways of doing it as well, please let us know. I'm always willing to learn from others as well. So if you have some golden nuggets, please do share it with us on the Facebook group, preferably. That would be really nice. But yeah, let's from here, let's go close this topic and let's go to some of the listeners' questions. And the first one is from MB, and we get this question sometimes, and he's asking, "What about Japanese stocks? Do you find them interesting because of the cheaper yen?"
Yeah, I'm not surprised we're getting asked about this with the yen and getting hammered, but I haven't looked at them. There are some Japanese companies that I like. I give example of Kians before. I'll give them again. They are Japanese companies I like, but honestly, I haven't felt the urge to move into the Asian markets. I think
Mm,
watching what happened with Alibaba in particular, it just showed me I don't really have the appetite to risk in Asia. And it comes back
yeah,
to risk. It comes back to risk.
yeah.
I mean, we don't, not that we can control Europe or America, but I think I understand them a little bit more. I struggle with Asia more than that, and information is a lot more freely available to me in Europe. So
Yeah, and that also then, I mean, there's nothing against Japan itself, right? But it's just also you need to start building knowledge again in another geographical
yeah,
area,
of
understand
course.
how consumers think and such. So for me, therefore, it's also more than enough. Europe and the US, it's already a really large stock universe.
MH79. If you had to buy one stock today you don't have in your portfolio yet, what would it be?
Uh, yeah, so I find it really hard to answer this one. But if I would choose one, I would probably creating initiating position, maybe a Nike.
Hey, they're getting cheap. Well, I don't know cheap. That's hold on. That's a big
No,
statement.
they're not
That
getting cheap, but
they are dropping in share price.
yeah, but there's a sentiment with Michael Jordan, and I saw his documentary also not too long ago, and those shoes are really great. So it would be more like for me, not from a valuation point of view, but more sentiment.
Yeah, probably on that note, it'd be someone like Berkshire Hathaway.
Oh,
I don't have
nice
any
one.
shares, but if I was going to pick one that I just wanted one share and just leave there, it'd probably one of those guys.
Nice, nice.
Jesper has asked us, where do you see the growth story and value in Ahold? Can they compete with the many discount stores? As he understands it, Ahold are not a hardcore discount store.
Um, Yeah, that's true. I lived in the Netherlands, and I see this question as directed towards the Dutch stores because we're not talking about the US here. But look, there's also a certain, at least when I was still in the Netherlands, if you go to Ahold, it also shows kind of that you can afford it. Yeah, so there's also something premium to Ahold. And I think that's important to understand when you think about the brand. Not everyone wants to go to Lidl, and not everyone wants to be seen with a bag coming home from Lidl or Action. Yeah, there's sentiment to that. And that's important. And Ahold supply chain is so superior to most of the others in the Dutch landscape, and also where their shops are. They have what is 100 year of history. They are at top-notch locations. They have the money to be at the best locations. So even it is like that for many people, there's not in their surroundings, let's say, so much alternative. Of course, you've got the Jumbos in the Netherlands and the others and such. They have also been really doing well lately, but they're also not the cheapest. They're also kind of trying to be an Ahold. So I think it's important to know that not everyone wants to go always to the cheapest retail discount store.
Yeah, there's a certain element of keeping up with the Joneses, I think, in
Yeah.
places. And do you know what? Location is really important there.
Yeah.
I have an example close to home, and if people in my area are listening, they might not be too happy. But there's an area not too far from where I live, which is known for its snobbery, let's say.
Yeah.
Okay, even though they're not the people, some people are nice, but they still have this air of snobbery about them. And we have this one store called Arkeen Stores, and there's a little right beside it, and you can buy the same thing in both shops, and it'll cost you 3 times the amount in Arkeen Stores. Okay.
Yeah.
But Arkeen Stores is jam-packed every single day, every hour of every day, because people want to be seen in that area shopping in that shop. It's crazy.
Yeah, exactly. It's exactly. But then also think, there are other reasons for going to Ahold. Ahold with their app, they were the first supermarket chain with an app where you could create your shopping list, and then you could order your shopping list by the path of the shop where you would go for shopping. Yeah, that's what I still remember in the early 2000s when mobile phones were just there with apps. How is it? Another one is their Shop and Go. I forgot how it's called, but they were at every station in the Netherlands. And there, that was so funny. You could buy at the time like an apple for 10 or 15 euro cents, and they would sell packaged apples sliced in pieces for €1.50 or something like that. So for people that were going by train, they would quickly jump in there. They wanted the coffee and something healthy. They would take a sliced apple. But imagine the margins on all this stuff. Yeah, this is Albert Heijn. Yeah, here. So I can't really talk about the US from that point of view. But Food Lion seems to be also quite a decent shop and such. But that's for me really why I see that Ahold has this pricing power. And then last but not least, Ahold's own brands are really, really cheap and really, really in desire. So they offer something to the low-income people as well at the same time.
Yeah. Good question. Paolo has asked us, $3 and Dick's, their earnings, their stock price is falling in relation to some thefts that have been happening in some of their stores recently. Does something like this in your portfolio concern you?
Well, it's impacting Target as well, right? And there are those videos online that shows how some shops are massively being robbed by many people at the same time. And I don't know what's going on in the US there, but let's not go into how is it political laws and these kinds of things. But it impacts Target, and I hope they get it sorted. Yeah. Does it concern me? No, because it's a small position.
Yeah, if it's a short term thing, I mean, I assume if your management and your stores are being robbed in a certain area, you're going to close it down. If your stores have been robbed in the whole area, every single area, you're either in the wrong areas or there's a bigger problem. That's the way I would look at it. I don't think it's in the wider area. I think it's constricted to certain pockets. So I'm sure management will take actions to either close them or move them to better areas. Seeking Arum has asked us a good question. Why invest in dividend stocks when you can invest risk-free in the US 10-year Treasury with an over 4% yield?
Because that Treasury yield doesn't grow my income.
That's a good answer. Next question from Marek is, you've answered this already, but I'll just repeat it, is what do you mean saying full position full and target time, or for now? I think you've answered that already.
Yeah, but how about you?
And for me, full position is full position completely. That might change when I reach my goal and I make a new goal. So
Okay.
if I want to increase my dividend income, say from 50,000 to 70,000, then I might readjust. But it's full position in terms of my target goal right now.
Nice.
Thomas has asked us, he said, 3 years ago, I started to invest in stocks, and listening to your podcast gave me lots of insights. Glad to hear that. Currently, some sectors look undervalued, such as insurance, real estate, investment trusts, telecom, and utilities. What are your thoughts about the utility sector? And he talks about tickers such as Fortis and UGI Corp and TC Energy.
Yeah, so I'm not a specialist in the utility sector. I hardly analyze it because I'm not so interested in the stock. So maybe a little bit about UGI. I screened it at least. So for the people that don't know it, UGI Corporation is a company that actually with operating both in the United States and Europe, it distributes, stores, and transports energy products and services through those areas, right? So they have Amerigas Propane, UGI International. They've got midstream and marketing business, and then utilities. And look at the dividend profile. It has a yield of 6.6%. It has a dividend growth rate of 5.6%, a payout ratio of 51%, and 30 years plus of dividend growth. So for me, that sounds like a very attractive company to move to the next step from screener to analysis, and I might do that here. So thank you also for bringing it to our attention, Thomas. And yeah, I think you might be onto something there.
Yeah, and I think I mentioned to you off air, I think this would make a very good topic for the podcast, particularly around undervalued sectors. I think it's something that we haven't done. And he's listed 4 sectors. There's probably more that would be nice to look into. So maybe we could do that sometime next month.
Yeah, sounds good.
Good. Anders has asked us, would love to hear your thoughts on Assa Abloy versus Allegion. Competitors in the same sector. Both companies have good moat and a great dividend history.
Yeah, so I haven't studied Allegion enough. That's why I would go for Assa Abloy at the moment in time. But I think this is something we should get back to. I think I like really the comparison conversation here. Assa Abloy inspired me to buy a lock picking set, and I've been teaching myself a little bit how to pick locks, so that's really interesting. And we should probably do a heads-up. A head-to-head comparison between the both of them, maybe on the podcast, maybe on a blog article, something like that. So Anders, stay tuned. We might get back to this one.
Okay, nice. Wolf of Harcourt Street. Actually, no, I skipped a couple. So Jonas has asked us, what are our thoughts on investing in BDCs? I think we're
not my circle of competence, so I stay away from that.
Yeah, I think we were asked this quite recently. And I did suggest going on to YouTube. Dividend Bull is there and is a lot more knowledgeable. I'd hate to pass on information that would be false, but his videos seem quite good in that area. Javier asked us to talk about ticker symbol NEE, which is Nextera. I would recommend checking out Jeremy's blog article on this. Jeremy was on this show, must be nearly 2 months ago now. But he wrote a very, very in-depth and nice article on them. Literally a week later, he posted it in the Facebook group again, but we'll try to dig out the link and stick it here again. Next one is, of course, from Wolf of Harcourt Street. Any thoughts on Aden as part of your mad money portfolio allocation?
Yeah, so maybe we need to pronounce it differently. It's Adyen.
Adyen.
Yeah, Adyen is like Stripe, such a payment provider, and a really, really fast-growing company, and their share price dropped by 40% or something like that, so losing 20 billion in a matter of 1 or 2 days, because effectively their income was flat, I believe. They have been hiring people like crazy now that the opportunity was there, so their margins dropped significantly. So share price went from, I don't know, 1,500 to around 750, 780 right now. Of course, it caught the attention of many people because it was one of such growth darlings on FinTwit. Yeah, I've been actually looking at it. I think that the share price is, let's say like that. I haven't done a valuation. Let's say it differently. I think that the market is heavily overreacting. I think the company has done really well to invest in their in talent right now. Now that the opportunity is there, because it's really hard to get good talent in IT. That comes at a cost, simply like that. And I think it sets them up for the future to do even more, because what I also understood from CEO, they were always constrained in what they could deliver because of the lack of people. So they've been able to kind of invest in that, bring costs forwards with that. So I think this is one of those moments that the market is short term, where you can see the short termism of the market. But if you have a long term view and you like the company above €1,000, then you must love it below €1,000. I haven't done analysis further, so I can't say anything about the value, but I think just in general, the response to such a report where the company is investing in the long term, that shows a little bit the craziness of the stock market.
Okay, the next question is from El Cuba, and he's asked us about our thoughts on Jerónimo Martins, ticker symbol JMT, which I believe is a Portuguese stock.
Yeah, and that's true. And I know why El Cuba is asking that, because they own, I think, probably the biggest supermarket chain in Poland called Biedronka, which is, I think, how do you call those little insects? Ladybugs?
Yes.
The red ones with, that's the logo of them. And they also own Hebbe. Hebbe is kind of a store where you can buy perfumes and these kinds of things, toothpaste, that. So, and there are like 3,400 of those stores. I mean, there are a few in my village where I live. I go shopping there almost every day. So when we go back to Jesper, that's not a premium brand supermarket chain. It's just around the corner for me. And really good. It's always packed there, always people there. Everyone knows this brand as well. So it is a really, really a good position in Poland, as far as I can talk about. So I don't know how they're doing in Portugal with their chains, but there's one thing just turning me off here. They have they have a dividend policy which is about paying out 40 to 50% of their consolidated net earnings. And what this leads to is to fluctuating dividends. So in 2017 and 2018, they paid 61 cents, 2019, 33, and then 35, 29, and now 79. Yeah, and the payout ratio now went to 100%. I don't know why, but for me, this is too much roller coaster in dividend payments for me to like this company. So it's therefore, for me, it's not a candidate. But I rather buy my stuff at their shops, because I keep some money in my pocket and to invest in dividends or in companies that actually grow their dividend.
Nice. I honestly would have never heard that company, so I'm glad you did. Next question is from Hobby Investor, and he has asked us, what do we think of the debt levels of British American Tobacco? And from my memory, I don't think it was too bad. Their long-term debt to equity was sitting around 50%, if I remember correctly. They have a current ratio of around 0.5. Interest expense was around 7.6, I think. I was only looking at them a few weeks ago. So I don't think their debt levels were actually too concerning for me. But honestly, I haven't looked deep enough in the last few weeks to give a proper answer, but it wasn't something that I remember being concerned about.
No, the same for me. They did this major acquisition. Was it Reynolds or something like that in 2017? Yeah. So that's when their debt ballooned. But come on, the debt is half of their shareholders' equity or something like that. Free cash flow is having a 50% payout ratio. So I'm totally not concerned about this. So what do they have? Last time I checked, yeah. So I'm looking at my dashboard here. It was like a 37 billion, that'd be 40 billion debt now against 75 billion in cash and equity.
Yeah.
So no, I'm actually not concerned.
Yeah, I was thinking when I saw that question, I felt like, have I missed something? That's that's what came to my mind. But no, there was nothing that overly stuck out for me when I was looking at them. But I'm due to do an in-depth review of them soon. So maybe that'll throw up something
Yeah.
that I've missed. Good.
Yeah.
The investing dosage has asked us, what are your thoughts about the current levels of T Rowe price and MPW?
Well, I think we spoke about T Rowe price before. I like it here. Don't expect any fireworks in the near term. Dividend well covered, no debt. So I'm happy with T Rowe price. I own it. I've been buying around this price level. So good one. And yeah, I think we spoke about medical properties trust already. Really, guys, my advice is please stay away if you want it as part of your dividend growth portfolio, unless you felt like this was the big reset. Their business is healthy enough and there's lots of potential going forward. I would like to challenge you in this interest rate environment, and we don't know when that stops, these high interest rates. So yeah, good luck with the owners, of course, of these shares.
Yeah. Herman has asked us about the Hershey company, ticker symbol HSY. The company seems to be becoming attractive. I can see you're smiling. You like this company. The company seems to be becoming attractive, or should we wait for the cocoa price to drop and wait for the effect of El Nino in the coming years?
You know what El Nino is, right?
It's some sort of
El Nino is this, yeah, exactly. What is kind of influencing the whole climate. Look, for me, Herman, really simple. There are some companies that I do valuation of, and some companies not. Really simple. Hershey, I buy it when it trades at 2.75%. Dividend yield, it hasn't been trading there for a long time. Last time it did is when I bought it. It was at $100. It went into the stratosphere. I like this company. Everyone wants chocolate. This one of such sleep well at night stocks, but at the right yield. And for me, 2.75% is a good one. They continue hiking the dividends, so I'm really happy with this one, and I would love to own more.
Oh, okay, it seems to be coming. Attractive price. I will say the only El Nino I knew before this was Fernando Torres, played for Liverpool. But no, nice, good company, and I don't think waiting is a good idea. We don't know what will happen. So if they're becoming attractive now, why not buy them now? Long-term view. Pash has asked us, what do you think about Disney? Sell or hold?
I don't even look at them anymore. They first need to pay a dividend that's covered by cash flow. Then I will look them up again.
Yeah. The next one, or the last one, is from Paul Kitt, and he's asked us, what are our thoughts about Broadcom, ticker symbol AVGO? He feels it's such a strong dividend grower, and it's not mentioned anywhere near enough. We don't mention them enough on here. I think we have spoke once or twice about them, and we did have a show, I remember, way back in the beginning. Remember, we had the guy from South Africa, John, on, who was a huge advocate of Broadcom. It's someone we probably should talk about more, because they do have a really good history. I think someone gave a good example on Twitter recently, but look, we don't, and I honestly bypass them quite a bit. They kind of fall out of my range.
Yeah, for me, Broadcom, usually these things come also on our table when they're really attractively valued, right? Yeah. And then we speak also a bit more about them. Look, I always disliked the way the company does business, but it made people filthy rich there. So definitely one of those companies that I've been misjudging here. It's a beautiful growth story what you're seeing there with Broadcom.
Yeah. Hey, sometimes we get stuff wrong. So
yeah, exactly.
Okay. That's it. Thanks to everyone for all your questions. Really appreciate them. Would love to hear your thoughts on the show. Obviously, we would love to hear your thoughts on whether you'd like us to do. I think we mentioned 2 topics: one about undervalued sectors and one about comparing asset abloy as well. So, which one would you like us to do next? And we would possibly do that. So, Until then, see you next time. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.